in Chapter 1, we look at the big overview, of what's the purpose of the financial statement. So the chapter talks about a variety of things, and you will want to read it. But one of the components of the chapter that I want to go over is the general purpose of the financial statements. So here I've kind of, this is supposed to be a bell. I don't know how well I've drawn that. But so here we have Bell Company, and if Bell Company needs money, so let's just assume that Bell Company needs the money. Well, I mean a big chunk of money, like $500,000 or $1 million. Where are they going to get that? Especially if they don't have it internally. Well, they're going to look outside themselves. And so outside the company, there are what we call capital providers. And so there's a variety of capital providers. One are the kind that you and I are more familiar with, the creditors. Creditors are often called lenders. So the creditors or lenders, those are the financial institutions. So we can go to a financial institution like a bank or savings and loan and borrow money from our creditor, or sometimes we call them the lender. But also uniquely to business, we can get equity investors. So we could sell stock, ownership rights. So those are our equity investors. So again, we can go to a bank and borrow money, or we could go and sell stock. And then also, in the course of things, there are other creditors that a company can have other than a financial institution. Their suppliers often loan money, especially if you're purchasing your goods from them. So suppliers, perhaps, borrowing from a union of the employees or something of that fashion, and customers, perhaps. But the most common, again, and usually the larger dollar amount, are going to be these financial institutions, and then also our equity investors. Well, before they make a decision whether to lend or invest in the company, they need information, right? So these particular groups need information that will help them make the decision. So actually, let's add to that, they need useful information. And that's where the accountant is going to come into play. So Bell Company then is going to create financial statements. So Bell Company is responsible for generating these reports called the financial statements. I'm just going to abbreviate financial statements here. And then all of these capital providers will read them to make their decision. So again, the big objective here then, the financial statements, is to provide useful information for decision making. So the big objective again of the financial statements is to provide useful information for decision making. And before we leave this little visual, I want to add one other point. Our financial markets wouldn't survive if this was the full picture. Because here's the problem. Bell Company is highly motivated to make these financial statements appear as wonderful as possible, because it's portraying, right, the financial outcome and the financial results of Bell Company. So, and that may be slanted in such a way that it's not useful for the investor and creditor. So that's where we have the independent CPA that's going to come in and audit those financial statements. So I like to think of the independent CPA somewhat like an umpire for a baseball game. They call, whether the balls are fair or not, or in or out, or that sort of thing. And again, the CPA is coming in and vouching for these financial statements. So in many ways, the CPA's role is to provide credibility for those statements. So again, to provide credibility for the financial statements. Okay, and so then we do have reliable, assuming this group, the CPA, does their job properly, the financial statements are reliable, and investors and creditors can make sound decisions on them. By the way, it doesn't mean just because the CPA vouches for these statements that the company is financially healthy. It just means that the numbers and what's reported on the financial statements are fairly and closely, fairly reported. It may be that the company is in dire straits financially. They can still get a clean audit opinion. It's up to the investor and creditor to read those to interpret that the company isn't financially viable. Okay, next step. Who makes the rules in accounting? Because these are all accounting's man-made. Somebody has to set up the rules. Well, if you're a private company, meaning you don't sell your stock to the public, we have the Financial Accounting Standards Board in the United States. So the FASB will create the rules. And at the international level, we have the International Accounting Standards Board. Here in the United States, we haven't yet adopted the International Accounting Standards. So the primary rule maker is the FASB. Now, having said that, it's kind of interesting because the FASB and the International Accounting Standards Board often meet together. Sometimes they will actually meet together and talk about accounting rules and try to set them up so if there's a new pronouncement or new rule, that they're in line with one another. Sometimes they agree, sometimes they don't. If it's a publicly traded company, meaning that stock is sold to the public, the Securities Exchange Commission legally has the authority granted by Congress. We have the authority granted by Congress. Congress, right? To establish the accounting rules. So they've got the legal authority to set accounting standards. However, they often just hand that over to the FASB and let them review it as well. Okay, and then the other thing, if you haven't looked at the Sarbanes-Oxley Act, if you will read, I'm just going to, page 18 of your textbook will refer you to that as well. But, there in 2002, when that was created as an outcome of a lot of accounting financial frauds, Congress came in and created this act, and it actually changed a lot of the authority of the accounting profession. Now we have more oversight from the government. Okay, and then down here I also include the definition of generally accepted accounting principles. Those aren't only rules. Sometimes we may have specific rules about things, but in other times, and sometimes it's just a convention. Just industry has just always tended to account for something a certain way, and that actually has become GAAP, generally accepted accounting principles. So GAAP may be a clearly defined rule, but it may just be that everybody's used to doing something a certain way, and that is GAAP. Yeah. Okay. I also want to talk about, if we've got these capital providers, well, what do they really need? So again, financial accounting, especially intermediate accounting, we're really looking at these external decision makers. So our focus on these financial statements, is really reporting financial statements that external users will use. Of course, management will look at them as well, but it's the external user that is our primary focus in this course. Okay, so what are they looking at, these external users, the investors and creditors? Well, they want both the return of their investment, right? They want to get their money back, but they also want to get a return on their investment. They want to get more back than they invested, right? So return of their money and an additional return on it. Well, let's think about, what is it that an investor does? Well, an investor buys stock. So when they spend, so they're going to buy stock, so they're going to spend cash, right? Cash is going to go out of their pocket. Now, they have the option of holding the stock. Well, they actually might get cash if they hold it if dividends are received. So they might hold the stock and get some dividends. And if they do, if dividends are distributed, they'll get some cash. And then, of course, ultimately, someday they're going to sell it and they'll get cash for that. Let's look at creditors. Creditors loan money. So they're going to spend cash, right, out of their pocket. And then they hope to get that money back, right, the principal back. And in addition to that, they want to get interest, receive interest. So they're going to get, hopefully, more cash back than what they spent. But what I want you to focus on all of these are cash flows. All of that is cash flows. So that's why, number two, these capital providers are concerned about the amount of the cash flows, the timing of the cash flows, those future, how much, when that cash comes back in, or hopefully comes back in, when the cash comes back in, what's the amount, timing, and what's the uncertainty of actually getting their money back, plus a return on their investment. So when I think of uncertainty, really that's risk. What's the risk or the uncertainty of their prospective cash flows for these companies? So because since investors invest in and creditors lend to a particular company, their current and future cash receipts are affected by the cash flows of the company. So the investor or creditor is trying to project their own amount and timing. When are they going to get their money back, plus a return on their investment, and what's the risk with that? So not only they're concerned about that, but in order to project that, they also have to project the cash flows of the company in order to project their own returns. Follow? So they're going to look at the company they loan money to, and then based on that, they can project their own amount, timing, and uncertainty. So the company's ability to generate net cash inflows affects both its ability to pay its dividends and interest, and the market prices of the securities, which in turn impacts the investors' and creditors' cash flows. Okay, third point. They are interested in how well the company's management has discharged its stewardship responsibilities. And here's where management needs to be looking in the best interest of the company, not management's personal interest, not their salary or their bonus and that sort of thing. Management needs to be focused on what's good for the company. Okay, then, what's the information? You're probably already familiar with most of this, at least the main things. But the balance sheet, obviously, is a primary, one of the primary financial statements. And so, it's going to, disclose the economic resources, which are assets, and the claims to those resources, which are the liabilities, and stockholders' equity. So that's the basic of the balance sheet equation, right? Assets equal liabilities plus stockholders' equity. Okay, and we will look more closely at the balance sheet in Chapter 5. And when we get, so Chapter 1 kind of gives an overview. We'll see this all over again in Chapter 5. It's going to help the external users identify strengths and weaknesses, help assess liquidity, how quickly the assets can be converted to cash, the solvency of the company, is the company going to be able to pay its debts, and its financial flexibility. Can the company respond, in a timely fashion if something bad happens or if they have financial adversity? It's kind of interesting. If you look at Microsoft's balance sheet, about 70% of their assets are cash. That's just amazing, isn't it? About 70% of their assets are cash. They're a highly liquid company. And they do that in order to maintain financial flexibility. Because high-tech companies, especially the big ones, the way they maintain market dominance is by going out and buying other smaller companies or other startups, right? That's how they maintain their dominance in the industry. So they need lots of cash in order to be able to do the buyouts. The income statement is really measuring performance, right? The financial performance of a company. So we're really evaluating management's performance, right? Management's in charge of stewardship. So we're evaluating, did management do a good job or not? We do this by looking at the past performance of the company, and that allows us to compare ourselves with others. It's also a basis for predicting future performance. So we look at the past in order to predict the future. And there again, we're going to it helps us assess the uncertainty of achieving those future cash flows. Chapter 4 in this textbook will look at the income statement even more closely. Statement of cash flows will be Chapter 5. when we get to it. And cash flows tend to be broken out into the three categories: operating, financing, and investing. Of those particular three cash flow qualities, I'm going to actually bump to a blank page. I'm going to talk about those three categories and do it in a way that hopefully will make some sense. If we think about, we can, if a company needs a big chunk of money, they can borrow or they can sell stock. So a company will tend to finance, right? It's going to get money, right, by borrowing debt or selling stock. And that money will come in, right? That money will come in, and the company's going to invest it in their assets. So if we had a lawn mowing company, we might borrow money from the bank. We might even just ask our friends, hey, I'll sell you some stock. Give me, if you give me some money, and you can share in the ownership of the company. So the money comes in. We might buy lawnmowers then. And then we're going to use our lawnmowers to generate revenue. So we can, again, I might put some words here. We're going to finance with debt and equity, and we'll use that money to invest in our business. We invest in the assets, which if it's a lawnmower, we will use those assets to generate revenue, right? We earn revenue when we provide goods and services. So we mow yards. When we mow yards, which is our service, we earn revenue. And then hopefully, that revenue will result in profits. Hopefully it'll result in profits. And if we are profitable, that's going to make these folks over here happy, right? That will satisfies our investors and creditors. Alright? Okay, now let's break this into groupings. So for the cash flow statement, we're going to kind of divide it up like this. Okay? Over here, I'm just going to put FA for financing. So any cash flow with debt and equity, and actually it's going to be long-term debt, any cash flow with long-term debt and stockholders' equity is a financing activity. Any cash flow over here with long-term assets is going to be an investing activity. And then all this over here, where the core of our activity takes place, these are operating activities. Because, we're going to have revenue. We also will, before we get to net income, we're going to incur expenses as well. So we will incur those expenses, which will result in net income. But anyhow, that gets at the heart of the three cash flows. We finance with debt and equity, we invest in long-term assets, and every other cash flow, cash received from revenues, cash paid out for expenses, those are operating activities. Okay, so there's our cash flow, and it helps us assess liquidity, solvency, and financial flexibility. And then the statement of stockholders' equity, we will look more closely at that in Chapter 4. It's going to look at contributions and distributions to owners. So if contributions, so if we sell stock, then the investors are contributing cash and we give them stock. So contributions mean when the corporations issue stock and cash comes in, that's a contribution by the investors, which are the owners. If we distribute, that's a dividend, isn't it? So if we distributions to the shareholders are in the form of dividends. Yep, let's get this right. There we go. So contributions are when we issue stock or sell stock, if it's a corporation, and distributions of earnings are in the form of dividends. Okay. Now, one other thing, you should find in Doc Sharing, I have posted the study guide, and this is just from the publisher of the textbook. This isn't something that I or your teacher put together for you. I'm kind of posting these for you for the first couple of chapters, but they're in Wiley Plus. I just want to bring them to your attention. You may find them helpful as the term goes along. Because really, I mean, they're just an outline of the chapter. They don't they are not going to replace the chapter. You can't just read the study guide and really understand everything. But they are. I think you'll find they might be a good resource for many of you, depending on how you study. I just want to point it out, and certain things that I would highlight for you. Again, the nature of the financial statements. Okay, and then the nature of the financial statements. And again, you can just kind of read through here. I've kind of already gone through a lot of this, but I just wanted, again, pointing out different things. Again, you can go through and just read. And I've underlined all of this and what's available for you as well. But what's the objective? What's the role of the SEC, the Securities Exchange Commission? You should definitely know, what is their role? What are accounting principles? What's the role of the FASB? Understand the FASB's there is a due process that they go through. They just don't quietly, they just don't secretly make the rules for accounting. They actually have a due process where they allow everybody, if you want to contribute and share your thoughts with the FASB, there will be an open period of time where we can all send to them our ideas and our thoughts on a certain topic. The other thing, this codification is where they kind of keep all their rules or their standards, if you will. We will be looking at how to use that codification later in the term. So you need to understand what it is, because we're going to be spending some time with it down the road. The International Accounting Standards Board, who are they? What is IFRS, the International Financial Reporting Standards? Should be aware, the IFRS is not part of the U.S. Generally Accepted Accounting Principles yet. Not yet, anyhow. And again, so there you have it. Also, some key terms. What are the accounting standards? Who's the AICPA? What's the codification? What's the financial accounting concepts? Financial accounting concepts, we're going to see that very heavily in Chapter 2. Financial accounting standards, the FASB, GAAP. GAAP are standards. Standards are the adopted rules. Procedures are, common conventions that are methods used. International Accounting Standards, IFRS, PCOB, that was created, that's a governmental body created under the Sarbanes-Oxley Act for auditing, not accounting so much, but for auditing standards. The Sarbanes-Oxley Act almost turned the accounting world upside down, because, it was an outcome of all these frauds, accounting frauds, and the Securities Exchange Commission. And I added a little note there too. All publicly traded corporations have to file their financial statements with the SEC. Now, if you're privately held, you don't. Okay, that's it.